5 reasons why Forex trading bots fail. And not just Forex, but any trading bot will fail if it has any of these 5 criteria. And the reason you should listen to me on this topic is because over the past 6 years, I've tried literally countless different bots and have failed with a lot of them. And for the past 5 years of my life, I've dedicated it to studying what really makes algorithmic trading work and what makes it not work. And on top of that, we've developed now what I believe is probably the most successful algorithmic trading group on the internet. So if you're somebody that's considering trading with a bot, or you are currently trading with a bot, make sure that it does not have these 5 criteria or you are doomed to fail. It's almost guaranteed. Okay, for the first reason why trading bots will fail is because they are overfit. Now, this is something that I didn't understand early in my career, but it's really, really important to understand. What overfit means that the trading strategy is too tightly tuned to historical performance. So let's say, for example, that we use a key and a lock, right? And we have this key that is this certain pattern that fits specifically in this lock. And if you put it in this lock, then it works perfectly. However, if we take this same key and we go next door to our neighbor's door, and he has a different lock, obviously, and we put that key into that door lock, it's not going to be able to open the door. Now, why is that? Well, it's the same thing that happens in trading. If you have a trading strategy that's so tightly fit to one market, when the market actually changes, which is bound to happen, market conditions are always happening. If it changes slightly, because you're so overfit, it's not going to work in different market conditions. So rather than this really specific key lock, what we want is we want something that's more like a Swiss Army knife, which, may not be the best tool for every single job, but it's round enough, or it's robust enough, or it's general enough to work with a lot of different situations and can be helpful in a lot of different situations. Now, we want our trading strategy to be the same way. A really easy way to see if some trading strategy is overfit, generally you'll look at, somebody that's selling this bot or whatever. It'll be this really, really smooth, tight back test that looks flawless, that has high monthly gains with really low percentage drawdown, and it looks really appealing. But if you take it out of sample, meaning that you take this out of the box, so let's say that you built this strategy on the past 6 months worth of data, and now we start trading it and you notice that it starts to fail really quickly, then you know that this strategy was likely overfit. Another way that you can decide if something is overfit or not is, let's say that the trading strategy was again developed over the past 6 months worth of data. Well, we could then go test it on out of sample period. So let's say that we go and test it on a year back worth of data, and we see how did it perform in this sample period, which was outside of the data that the algorithm or the bot was actually trained on, to get an idea of the robustness of the system. So most trading bots fail because they are, number one, they're too overfit, meaning they're too tightly wound to this historical data. Now, the second reason why trading bots will fail is because they don't adapt to changing market conditions. Now, as you know, Q1 of 2024 is very different than Q1 of 2023 or Q1 of 2020. And so the market is always changing. It's very rarely the same. And so a lot of trading bots will be built and it'll be kind of like a static bot that won't really change as the market conditions change. So if you have a bot that is not constantly being updated or tweaked or changed to fit the current market environment, then the bot is likely to fail. Now, inside our company, we actually have a full team of optimizers that are constantly going in and that are optimizing our bots every single week so we can see which strategies and which algorithms are working best for the most current market condition. And so a lot of the times you'll see a trading bot that may do really well. It may do well for 6 months, or it may do well for even up to 12 months. And you may think this is really, really good, but if it's just static and it's not changing with the market conditions, as soon as the market goes in a huge trend, or it goes in a trend of the opposite direction, or it goes flat for a long time, depending on the trading strategy, the strategy could no longer work. So if your trading algorithm or your trading bot is not adapting with current market conditions, then this is a red flag. The third most common pitfall that I see with trading bots is trading bots use improper risk management strategies, and more specifically, what I mean by that is martingale or cost averaging. Especially in Forex, one of the easiest ways to make money consistently is with a martingale type of strategy. And if you're not familiar with martingale, martingale is a betting strategy that was originally developed for blackjack, which basically means that on losing hands, you would double your bet. So let's say, for example, hand one was $5. If you lose, you double to 10. If you lose that, you double to 20, to 40, to 80, to 160, to 320, to 640, etc. And you just keep doubling down if you continue to lose time and time and time again until eventually you'll win and you'll be able to make back all of your losses plus the original amount, which was like that $5 that you're ultimately after at the beginning. And so to put that into trading terms, the way that it'll work, let's say that we have a market that's on a strong downtrend like this. It means that as the market moves against you, you'll just continue to place buy orders. So you take a buy here, it moves down, you'll take a buy here. If it continues to move down, you'll take a buy here. If it continues to move down, you'll take a buy here, in the hopes that the market reverses and comes back up to hit your take profit, and so you don't lose any money. And this is a lot of the times a psychologically easy strategy to trade because you'll see these nice consistent monthly profits, and there's actually some systems on the market that are becoming really popular that use this sort of martingale strategy. But this is a huge red flag, and the reason being is because you are taking an unlimited risk in order for a small return. And you can generally identify these martingale strategies because they generally have high win rates of like 75 to 85% win rate, so it looks really attractive. However, if you look at the risk to reward, generally your reward on average, your average winner is much smaller than your average loser. And when I actually first got into trading with bots, I was trading this martingale type system, which was really cool because I was making like 10, 12% per month. However, there was these times where it would go into this really sharp drawdown. We're going to like 20, 30, 35, 40% drawdown. And a couple times it actually recovered and we were able to get out of that drawdown. But I was too stupid at the time to get out of that sort of system. And I kept my money in these sort of systems. And eventually what happened is one day the market continued to trend against me so far that I got a margin call and it actually blew my entire account. And if you've been in this game long enough, you'll see that this happens over and over and over again. So this is commonly known as martingale, also cost averaging systems where you continue to cost average into the market. This is another thing. And if you're cost averaging or martingaling and you're trading with leverage like you do in Forex, this is a thing that may work for a while, but eventually it's just gonna blow up your entire account. And I made a whole nother video on our channel talking about this. The fourth reason why trading bots can fail is due to technical bugs. You know, trading with a Forex bot does require some sort of technical know-how, right? A lot of the times you're trading inside of a VPS or a virtual private server. And on top of that, you actually have to set up the bot and you have to make sure that it's constantly connected. And so any random technical errors can happen at any time with bots, which impose additional risk versus if you're just trading manually. So it's really important that if you are trading with an algorithm or a bot, it's important to make sure that the company that you're buying it from or renting it from, that you have access to good support and that you can get access to a development team if need be, so that way issues and bugs can be fixed quickly, because this does happen. By the way, before I talk to you about reason number 5, which is one of the biggest reasons why people fail trading with bots, if you're still not trading with AI and robotics to improve your trading results, then what are you doing? AI is changing the world, and for the past 4 years, we spent over $2 million developing what we believe is the best AI trading system on the market, specifically for passing prop firm challenges. So if you'd like to improve your trading edge and unlock $100,000 or more worth of trading capital, then go to www.propfarming.com to see the full demo of exactly how it works and how we can guarantee your success or you don't pay us a penny. So the fifth reason why people fail trading with bots is due to trader psychology. And you may say, Adam, how can this be a factor if I'm letting a bot trade and I don't even have to think about it? It's entering, it's exiting the trades, it's managing the risk. How could somebody possibly lose? And you may think that is right? And to be fair, trading with a bot is a lot less psychologically or emotionally taxing than trading manually. Without question, that's one of the big benefits to trading with bots, but still some people can manage to mess it up. You know, I've traded with algorithms that have been really successful and have worked for me, but some other people have traded the exact same algorithms and it didn't work for them. And why is that? It's because of their trading psychology. Some people were not comfortable with the drawdown. They didn't know what to expect. Some people are even dumb enough to go in there and to manually change things or to try to optimize or change the parameters even further because they think that they could have a better edge, or they don't like one way that the bot is trading, or they think that they're smarter than the bot. So they go in there and they start messing with the settings. A lot of the times this can ultimately lead to their disaster. So even though trading with bots does level the playing field a lot, it's not completely dummy proof. You'll be surprised how many people just mess this up out of their own stupidity because they think that they're actually smarter than the bot. So if you're looking to trade with a trading bot, or you're currently trading with a trading bot, be aware of these 5 red flags that cause people to fail. Oh yeah, and by the way, if you'd like to see a demo of our AI trading bot and how we created it and some of the results that it's getting, then go ahead and check out this video right here.